Japan's sudden U-turn on US Treasuries in early 2025 wasn't just another portfolio rebalance, it was a seismic shift. $119,300,000,000 reduction in their US bond holdings during Q1 marked the steepest quarterly drop since 2012, according to Treasury International Capital data, and more than we think may have been at stake. Why Japan hit the exit? On paper, this dump appeared as a technical tweak in response to domestic yield curve control shifts, a routine tweak by the Bank of Japan, BOJ. But whispers from economists like HSBC's Frederick Neumann and Bloomberg sources say it was far from benign. Tokyo's move signals a strategic hedge against what they perceive as growing instability in US fiscal policy and trade relations. Months before the sell-off, Japan had been quietly warning of US trade tightness. The Commerce Department slapped 25% tariffs on Japanese EVs in November 2024, shocking Tokyo and triggering stern rebukes from Nissan and others. When EVs powered by Toyota's solid-state batteries threatened US automakers, the tariffs began to feel less about trade fairness and more about economic containment. In that same time frame, Japan's finance minister openly called its huge US debt holdings a bargaining chip in negotiations, no longer bound by blind loyalty. The abrupt absence of Japan's bids in the Treasury market sent yields soaring. 10-year US yields surged near 4.9%, matching highs not seen since 2007. That spike means roughly $270 billion, 0 cents, more in annual interest obligations by 2027, per the CBO. And at the same time, the S&P 500 dropped about 5.4%, erasing around $1.7 trillion, 0 cents, in market cap within days. The dollar also took a hit, down roughly 2.1% in a fortnight, as central banks from Seoul to Abu Dhabi subtly pivoted away from dollar reserves. The message? A growing skepticism about the dollar's ultimate safe haven status. Is this the end of the dollar era? Not overnight. The IMF reports that global dollar reserves have slid from about 59% to around 54% since 2022, part of a steady diversification into euros, yuan, and gold. China's digital yuan now accounts for roughly 5% of cross-border settlements in Southeast Asia, while India's rupee is increasingly used in oil trade with Iran and Russia. Japan's move may not break the dollar, but it's another crack in the global financial architecture. Other countries, from Malaysia to Brazil, are hedging too, reducing dollar holdings in favor of local currencies, or metals. This sell-off wasn't random, it was a statement, quietly screamed. Japan's leveraged its bond holdings to counter US tariffs, especially after its solid-state EV breakthrough. With 48% of global solid-state battery patents, Japan holds strategic dominance and is now using it as global leverage. On trade, across the Atlantic, Trump's administration has doubled down on tariffs, now targeting electronics and chips from Japan and South Korea. The WTO is being populated with complaints, and even US courts have weighed in, calling into question the legal grounds of these unilateral trade moves. The domestic picture isn't any rosier. As bipartisan friction intensifies, Moody's put the US on negative watch, while global confidence in American institutions, legal and fiscal, is wavering. Could this unravel the global dollar system? It's possible, but not imminent. Central banks in Canada, the EU, and Australia are experimenting with reserve diversification and digital currency interoperability. Financial frameworks like BRICS Pay are being fast-tracked for launch by mid-2025. Former Fed Chair Janet Yellen recently said we're entering a more fractured monetary era where dollar dominance is no longer guaranteed. The world may end up with multiple regional financial centers instead of one global hub. So, is this the end for the dollar? Not yet. Japan, despite the big sell-off, still holds over $1 trillion in US debt, showing that while they're asserting strategic independence, they're not abandoning the dollar entirely. And experts stress there is no comparably deep or stable alternative to the US bond market yet. But this moment marks a turning point. The dollar's role isn't unchallenged anymore. And while a new global financial order won't rise overnight, seismic shifts like this one are laying the groundwork. If this feels like a turning point, that's because it is. For decades, US Treasuries were viewed as unshakable. Today, even a trusted investor like Japan is leveraging them as a geopolitical card. To my YouTube community, keep your eyes on US yields, Treasury auctions, and Tokyo's next moves, because each is a piece in a larger puzzle. And that puzzle is the future of global money. Let me know what you think in the comments below and make sure you're subscribed. I'll be breaking down every twist and turn as this new financial era unfolds.